kindly focus on the business performance. Yes, let's do it now. This is the highlights, right? When you give a headline, this is what they want to focus on. This is from Palantir themselves. Fourth quarter consecutive GAAP profitability. That's huge. GAAP EPS 3 cents. GAAP EPS is on the record, and this matters. This is for S&P eligibility. They got it. Now, we don't know when it's going to happen, but we know that they can do it now. F-share class companies are allowed to be in. We'll just see once that news comes out or when it comes out. I wouldn't hold my breath, just so you guys know. Now, let's look at the highlights here. GAAP net income, $72 million. We already know about this. Income from operations, $40 million. I like to see this. If you can make money from your business on a GAAP basis and not rely on other things like financial engineering, we saw that with the step-up basis from Japan, the Japan arm or subsidiary. That was in Q4 of 2022. But that got the ball rolling to hit this point of fourth consecutive GAAP profitability. So third here consecutive. Now, adjusted EPS, 7 cents, good. And just remember, for EPS in general, it's not something I look out for. I just care about them hitting it since S&P eligibility is on the table. But for growth companies, this is what I care about, revenue. We've covered this, 17% year over year, $558 million. They beat guidance. It was 553, I believe, to 557. They topped this. Awesome. Sandbagging, but they didn't necessarily knock it out of the park, which is fine. Commercial revenue, and I can't wait to see their presentation on the breakdown, but essentially we have it. They grew 23% overall commercial revenue. That's nice to see. Revenue for the U.S., they want to highlight 33%, meaning that internationally this is still needs to pick this. This hasn't picked up yet, but it's important that it's still growing. And this creates a baseline that's higher and higher. So if they can continue growing U.S. commercial at 33%, now 33% from previous to get to 116 is one thing. Now, if you want to grow 33% next year for this particular quarter, you got to do 33% now on 116. Now, moving to government, slowdown here. This has been a concern for some folks. There is more instability in the world. Let's be honest here. If you've been paying attention to the news, we know about Israel and Hamas. That came out of nowhere. Unfortunate civilians on both sides there. But government revenue can be driven by these kinds of events. Escalation by China, South China Sea. I'm Filipino, been to the Philippines. There's escalations there as well. And strategically, the Philippines is a thorn for the Chinese government and for the Navy in that area. Now, Taiwan is there. They want to get Taiwan at some point, but we'll see how this affects government revenue going forward. Now, customer count, this is important. 34%. Still a nice number. 30%, if you can compound that, that's going to be big because the baseline gets bigger. Now, I wanted them to stay aligned to 38%. I was thinking the bar's much lower. I'm not knocking them for this, though. 34%, still good. U.S. commercial count grew 37%. So we know that commercial customers in the United States, they're getting the most customers from. Now, I'm assuming this customer count is also inclusive of international government, commercial government, and then U.S. government. So that means with them over the bar here driving it, that means those are below 34%. And this specifically went from 132 customers in this category to 181. Now, adjusted income from operations, $163 million, fourth consecutive quarter of expanding adjusted operating margins. Basically you're just taking out the adjustments here. But since they already hit it on a GAAP basis, that's obviously a higher highlight. Cash from operations, $133 million. Great. Love this. Keep it positive. They stay alive. Flexibility. What you do with the cash is more important, but if it's coming in, that's great. Your business actually works. Adjusted free cash flow, of course, a little bit higher here after their adjustments. And treasuries, their cash balance sitting at $3.3 billion. Awesome work. Palantir, the biggest thing here, let's just go. Fourth quarter GAAP profitability, 17%, which is an inflection of the year-over-year growth of revenue from 13% last quarter. So that's big. Customer count is growing, not as fast as I thought, but it is growing, and that's great. And, we'll see how this picks up because of trials, I believe I saw 3 to 6 months. Very important. When you're a paying customer, that's when you're counted. So they will take this into account. Let's go to the Q3 Trailing 12-month highlights. Revenue 2.1. Yeah, this is for, I guess, for comparison purposes. We'll skip over this, but if you want the trailing 12 months, that's fine. But we covered the Q3 itself. Now let's look at the different summaries that they give here, and these are important. So we have that 558 million revenue, so that top line beat, 17% year-over-year growth. Outlook. Oh, sorry. Let's look at this first. Outlook. 599 to 603. Okay, everybody, let's remember this number here. 599 to 603. And let's keep that calculator open. And then we're comparing it to Q4 2022. This is where I want to see the quarterly year-over-year growth. Okay, revenue. 509 total. This is great. Now let's see. They said, too many tabs open. Let's close some of these. Oh, actually, sorry, pre-market. Let's look at this really quick. 1684, still sustaining. Yeah, it looks like someone knew about these results a lot earlier. But let's look at this. 599 low end guidance. 599. Oh, actually, 17%. So that's a sustain of the 17% revenue growth. Now, this is better than what we got last quarter, I would say, because now we have proof that they reached 17%. It's not the most amazing thing where they're hitting up even higher growth rates. But remember that baseline, guys. The baseline makes a difference here, percentages, as it accumulates. But 17% is not bad. We're definitely on the way to that above 20%. But like I said, that means the quarter after of Q1 2024 is going to be compared against Q1 2023. And that means to hit 17% again is going to be harder, and to hit 20%, that's going to be harder. So we have to see if AIP is working and driving that. But yeah, I don't hate that. 600 million a quarter. Well, let's just see if they hit that top end as well. 18%. That is nice. Now let's say they beat that like they did this quarter, right? Let's just say they do it again, 1 million extra. That's going to put them in 18.5% healthily. So this would be very cool if they hit this way. They're guiding, and we know Palantir, they don't miss guidance. Now, it's important to set realistic expectations. So you don't want to just raise your stock because you have awesome guidance, because you actually have to reach that. GAAP net income, yeah, that's all I care about. Now, full year, 2.2. Oh, this is great. They raised guidance. I talked about this. So 2.212 in excess was what they guided for full year 2023 back in Q2 earnings. Q3 now they've raised it. So they've capped it, of course, but 2.212 versus 2.220. And then this is the base, the bottom number here is higher now. So they've raised guidance. That is what happens. Now they're raising their adjusted income from average guidance between 607 to 611. That's great. Just seeing it raise up. And then continue GAAP net income each quarter of this year. Yeah. They've set the bar already. Why not? Why miss it at this point? So, oh my gosh, we're at 710 here, guys. But I'm going to keep going for this. Additional definitions. Let's see. Okay, let me just double check I didn't miss anything important. Okay, highlights. Guidance. CEO letter. Oh, wait, let me see this. Darn. That's okay. We got the webcast, and then you guys should be tuning in. I know that I'm not covering the call. They're going through the presentation. I'm going to put this in my video later on in the day. Gives me more time to digest, of course, and consolidate the kind of information. So check out this live. I know I got to listen to the call myself too, so that's going to be part of it. This might be one of my longer videos, but I'm just so happy that you guys are tuning in here. But let's just look a little bit through the financial statements that are on here. And let me just do a quick refresh. Yeah, what the heck? Well, I'll wait for this to come out. It's probably going to be, I guess, after the earnings call. So Balance sheet, great. It's a picture. It's a picture that's important because it shows the health of your company. First thing they put is the statement of operations. Sorry, guys. I just like going in the order of that. But revenue here, we can see the comparisons. Now, 9 months ended. This is the trailing, last 3 months. Sorry, trailing 3 quarters. But we're growing as a company. Now, the speed of growth, that's the biggest factor in terms of valuation. According to the pre-market, they're okay with this. So, that's cool to see. The biggest thing to see here, though, look at this. This is beautiful. This is beautiful, guys. Look at all this extra revenue that they grew, and then look at that cost of revenue. Did you know that Palantir is a scalable business? Last 3 quarters, 22 million more, yet you're bringing in almost 219 million more in revenue. I wonder if Palantir is scalable. Obviously, I'm being sarcastic, so you guys should know that. I see that your message here, Todd, about Chris. Chris is a solid guy. Just gonna say, Palantir, it's very divisive. There's a story to it. Obviously, you guys know where I stand on Palantir and my coverage of it, dedicating a channel to this. Like, you already know where I'm at. But everyone's got their own opinions on that. Now, here is the interesting part to operating expenses in a scalable business. Do you need to keep raising this in order to drive business, or do you not need to? Look at this, 182 down, driving more business. What does that mean? Well, it could mean that they're very effective now in their sales and marketing. That is possible, right? Or maybe the cost didn't hit Palantir yet. And maybe this can be an issue later on where we'll see raising sales and marketing. But with all the sales and marketing, the videos on their YouTube channel, the different PRs, I'm not sure how much cost actually goes into that. But AIP bootcamps, I believe, falls under sales and marketing. And either way, if we fall under the other expenses here for operations, look, 5 million more in research and development from quarter to quarter, less, 20 million less for G&A. And they're raising revenue from this. Palantir is a scalable business. Now, this is always great to see. Now, we know the baseline was much lower back then. They make money. That's all we need to know. And, an extra bonus, they got the cash. Like I said, I've talked about this, and everyone has an opinion on what should a growth company do with their cash. Interest right now, it's if you're putting it into treasuries, you're getting guaranteed rate. Well, depending on your time frame, right? The value of those can go down, especially if it's a long-term time frame, interest rates change. But if you're just parking cash, why not take the free? Well, it's free in the way that it's guaranteed, but it means that you're foregoing opportunities. But either way, look at this interest income, $88 million alone in the last 9 months. So obviously it's not going to push your valuations to the roof, but it just shows that if they got the money, it doesn't have to just sit there doing nothing. They can do something with it, and they're being prudent as shareholders. Prudent with management, I believe, doing this. I just like the flexibility of having a huge cash pile and positive operational cash flow. Going on here, this is where we flow to the net income. Great, and these are the per share, and then also the amount of share. So we know that this is going up. Now, this includes stock-based compensation expenses here when you add this. Now, leveling, and I'll probably cover this too in my video here, but at least on a quarter basis here, we see this is what people are going to see. Decrease. And I'm going to I have that picture up open, ready just for this moment. You guys love this graphic here. We should see this percentage go down. Revenue is going up. Even if stock-based compensation stays the same, percentage, that ratio will go down. And that's what you want to see. Yes. Now, I love balance sheets, guys. Am I a nerd? Sure. Whatever. Balance sheets, picture health of your company. Now, oh my God, their cash went down. Some people may not understand, right? And if you're learning about this, great. This is the best way. Practical examples, thinking it through. Oh no, they have no cash. Well, duh, because it's sitting in their marketable securities, treasuries. So their cash equivalents are huge, or total current cash, $3.8 billion sitting there. So no matter what, you could say Palantir is going to be worth what, $2-3 a share just in in cash. Obviously, we don't want that. This is not really cash here. Prepaid expenses, yeah, that's fine. But accounts receivable as well. But the cash itself, yeah, this is what's owed to them. So this is growing. And this is a sign of a growing business as well, accounts receivable. People owe you money when they buy your services. Businesses don't pay you on the spot like, say, a register at a fast food restaurant. They have invoices, net 30, things of that nature here. So if you have growing accounts receivables, as long as you can collect them, meaning that your customers are healthy and actually pay you in the end, this is great because there's going to be some loss, obviously, but this is growing. This is a nice telltale sign of growth. Now, let's see here. Yeah, healthy balance sheet, nothing red flag here. Accounts payable, that's fine. Liabilities, deferred revenue, that's fine. This is great. Seeing deferred revenue and customer deposits growing up, another sign of growing business. Yeah, no real current debt. I have to double check what these accrued liabilities are. But either way, it's insignificant. Total current assets of $3.8 billion versus $700 million in current liabilities. Yeah, negligible. And even if you take the long term here, so these are customer deposits, deferred revenue, the lease. So yeah, that's going to be their biggest thing, I guess, because it's probably expensive to have a whole office building. But the ratio here, it's obvious, right? Total assets of $4.1 billion. This includes the non kind of liquid stuff. But yeah, 4-to-1, healthy, no complaints. Now, statements of cash flow. What I'm going to do first is skip the operations and go back up. But first, you just need to see that this is positive. Great. Oh, sorry, I didn't skip it. I'll go back up to the details. But investing activities here. So this is used for investment purposes, aka buying treasuries, and then selling treasuries because they do short term. So this is fine, being negative. It still sits on their balance sheet. And now their financing activities. This is like if you're taking out debt or selling stock. And yes, they do raise cash from the exercise of stock options. Oh my God, $170 million. No, I don't think that's bad at all. I think I was trying to be sarcastic, but I know you guys might pick up on that. Sorry about that. But let's go back up to operations. This is what I love, bread and butter, right? This is what we want to see. Decrease. Depreciation and amortization, that's a non-cash expense. Doesn't matter. It's negligible. Let's look at the big numbers. Accounts receivable, yes. That's fine. So they're not receiving, negative cash. Spending the product before they get paid. Yeah, that's fine. Yeah, no red flags here, honestly. Healthy. The reason here, though, why it's that high, obviously. But since they have net income, they actually make money. This is big. Let's see. Non-GAAP reconciliation. This is on the adjusted basis. I know these were the big lines and the call is going on. Oh, sorry, wrong one. Yeah, they're still talking this through, and I need to review that. Sorry, guys. But I think this is it. Thank you all for stopping by. You guys are awesome. Please watch the other stream if you're going to cover the call, because I do have personal things I got to take care of, and I'm on stream much longer than I thought I would be, 7:20. I got to head out soon, but thank you all for watching. Look out for my video that's going to be consolidated, concentrating on the metrics that I care about. And you already have previews to my previous videos on what I'm probably going to cover, but I will be going through that. But thank you all for stopping by. You guys are awesome. And I'll see you in the next one. I think I'm going to be live streaming in the future. Thank you.